By now you can read a candle, name the 9 shapes of doubt, and spot all 6 formations that pay. Here's the uncomfortable truth. None of that is a trade. A formation only tells you where the market might turn. It doesn't tell you when to pull the trigger, where your stop lives, where you take profit, or when the correct move is to walk away. Amateurs see a pattern and click. Professionals run a protocol, the same 5 steps every single trade, no exceptions. Today you get the complete protocol. 1 entry rule, 2 stop numbers, 1 target method, 1 ratio, and the discipline rule that will save your account more often than any pattern ever will. 5 steps: trend, formation, entry, stop, target. Miss 1 and the other 4 don't matter. Let's build the checklist. Here is the whole protocol on one screen. Step 1. Establish the trend with real trend lines, not vibes. Step 2. Wait for one of your 6 formations to complete in the right location. Step 3. Enter at the open of the next candle, never before the formation closes. Step 4. Place the protective stop, 15 above a bearish formation, 10 below a bullish one. Step 5. Set the target at past structure and check the ratio, minimum 1 to 1.5. 5 boxes. Check all 5 or there is no trade. Now let's earn each box. Step 1. Straight from the method. Draw all your trend lines, inner, outer, and long-term. Not one line, all of them. They tell you 3 things: whether the market is in an uptrend, a downtrend, or whether a line just broke, which is the early warning of a reversal. And here's the number that makes the work worth it. If the candles are trading above the uptrend line, the market has an 80% chance of continuing bullish. Below the downtrend line, 80% chance the bearish move continues. 8 out of 10. You don't fight those odds, you join them. The trend lines aren't decoration, they're the house edge, and drawing them puts you on the house's side of the table. Same step, second rule. Trade only in the direction of the most current trend on the larger time frame. The latter is fixed. If you trade the 15-minute chart, you follow the trend of the 1 hour. 30 minutes? Follow the 2 hour. 1 hour? Follow the 4 hour. And once the big chart votes, your shopping list is set. Trend down. You hunt evening stars, tweezer tops, and bearish engulfing candles. Nothing else. Trend up. Morning stars, tweezer bottoms, bullish engulfing. Half the catalog goes in the drawer on any given day. That's not a limitation. That's the filter doing its job. And one place where the protocol says, stand down. Do not trade candlestick formations in consolidation. When the market is moving sideways in a box, every signal is noise, trapped between 2 walls. The method wants you trading the wave, not the puddle. As a trend moves, it breathes, it waves back, it retraces. That's your moment. When the market waves back from its trend, watch for one of your formations to print at the end of that pullback. Formation, at the end of a retrace, in the direction of the bigger trend. That's the highest probability sequence this method knows. Step 3. The entry. 2 conditions. 0 flexibility. First, the formation must be closed, every candle in it. A morning star with the 3rd candle still printing is not a morning star. It's a hope. Second, remember the 60% U-turn from the formations episode. The final decision candle must close beyond 60% of the first candle's body. Both conditions met? Then you enter at the market price, at the open of the very next candle. Not 3 candles later when it confirms. By then the move is gone. Not before the close. That's gambling on an unfinished sentence. Candles closed, U-turn done, next open, click. Step 4. The protective stop. And the method gives you exact numbers, not feelings. Selling a bearish formation? The stop goes 15 above the formation's high. Buying a bullish one? 10 below the formation's low. 15 above, 10 below, in pips, points, or ticks, whatever your market trades in. Why the asymmetry? Sell-side stops sit above, where spread on a bid chart bites harder. The method gives the ceiling more room than the floor. Write these two numbers down. They are not suggestions, and they are never just this once moved. Now, why 15 and 10 and not tighter? Because of what happens next. Before an army commits to a retreat, it probes the wall one more time. The market does exactly the same thing. Here is the statistic that kills the biggest myth in candlestick trading. More than 50% of the time, the market comes back to test the high or the low of the formation you just traded. It's a financial game between bulls and bears. After a bullish formation, the bears return to the low, probing for leftover selling interest. Nothing there? The formation holds and the rally begins. After a bearish formation, the bulls probe the high for buyers. No interest? The market dips. So when price crawls back toward your formation right after entry, that is not the pattern failing. That is the pattern being verified. And that's exactly why your stop lives 15 above or 10 below. It gives the test room to happen without taking you out of a trade that's about to work. Step 5, the target. First, you need to know what a past high actually is, because the method defines it with surgical precision. A high is a candle where 2 candles to its left and 2 candles to its right are lower than the center candle's wick. That's it. The colors don't matter. The 4 candles don't even need to be sequential. Gaps and overlaps are fine. 2 lower on each side. That wick is a high. Mirror it for lows. Scan left across your chart and mark them. Those wicks are the market's memory. Every past high is where sellers showed up before. Every past low is where buyers defended before. Now the exit itself. Selling? Find the 4 most recent past lows. Buying? The 4 past highs. Your profit target is a limit order placed 10 units in front of the past extreme. 10 above a past low if you're selling, 10 below a past high if you're buying. Pips, points, or ticks, whatever your market trades in. Why in front? Because the whole market can see that level, and a wall of orders sits exactly on it. You want to be paid before the crowd, not standing in it. And why 4? Because you'll choose the one, nearest first, that fits the ratio we're about to talk about. The market's old battlegrounds become your cash registers. And now, the number that turns all of this into a business, the ratio. Minimum 1 to 1.5. Risk 1 to make at least 1.5. Measure it before you click. Distance to your stop versus distance to your target. If the nearest valid target doesn't pay 1.5 times your risk, check the next one. And if the stop is so far away that no target makes the math work, here's the golden rule of the entire method. Pass on the trade. Walk away. Then go find another setup that does meet the requirement, on another time frame or another pair. There is always another trade. There is not always another account. Let's run the entire protocol on one chart, start to finish. 1 hour chart. Downtrend confirmed below the trend line, and the 4 hour agrees. Box 1. The market waves back up and prints an evening star. Strong bull, doji above, strong bear closing past the 60% U-turn. Box 2. Sell at market on the open of the next candle. Box 3. Stop, 15 above the star's high. Box 4. Target. Nearest past low pays more than 1.5 to 1. Limit order 10 in front of it. Box 5. Then the market does exactly what it does half the time. Rallies back, kisses the high of the formation, 3 short of the stop, and rolls over. The test found no buyers. Price drops, the limit fills 10 in front of the old low. Every box checked. That is a professional trade, and the pattern was only box number 2. Checkpoint, Protocol Edition. Buying a morning star. Where does the stop go? 10 pips below the formation's low. Selling an evening star whose final candle closed at 55% U-turn. Do you take it? No, 60 or nothing. Price comes back and touches your bullish formation's low right after entry. Panic or patience? Patience. That's the test, and it happens more than half the time. And the stop that's too far for 1 to 1.5? Pass. Say it with me. Pass. If you got all four, you don't have opinions about trades anymore. You have a protocol. The complete protocol on one screen. Draw every line and take the 80% side. Let the bigger time frame vote. Never trade the box, trade the wave. Enter only on closed candles, past the 60% U-turn at the next open. 15 above, 10 below. In pips, points, or ticks, whatever your market trades in, and when the market comes back to test, let it. 4 past extremes, limit 10 in front, 1 to 1.5, or you pass. That's the machine. But knowing the machine and seeing the setups in real time are two different skills. Next episode, we train your eye. 11 real charts, 10 seconds each. Find the formation before the clock runs out. Some of them, 90% of traders miss. Grab the free Candlestick code cheat sheet in the description, and I'll see you on the drill floor.